My name is Ronnie Michael, a certified public accountant, and this is the Personal Finance Playbook. Improve your finances, improve your life. The title of today's episode is Stock Market 101, All the Questions You Were Afraid to Ask. The stock market can seem chaotic and confusing. I'm sure we've all been at a party or work event. Someone made a comment like, the market is crazy right now, and then we nodded our head, not wanting to seem like an idiot. Pundits are constantly talking about how the stock market is doing. They'll throw out numbers and different terms and speak with great conviction while you sit there feeling like you should know more. Well, feel bad no longer. Let's start as basic as we can. What is stock? Stock is a financial instrument that represents ownership of a corporation. A corporation is a legal term for a specific way to organize a business. In everyday conversation, people will often use terms like corporation, company, business, and organization interchangeably. In a lot of contexts, it doesn't really matter what term you use. But when we're talking about stocks, we should really use the term corporation. When a business decides to organize as a corporation, it files articles of incorporation with the government. The term corporation has the Latin root corpus, which means body. You've probably heard before that for legal purposes, a corporation is treated as if it is a person. While that may sound a bit sketchy, it is true in some respects. A corporation, just like any ordinary person, can be sued, sue others, lend money, borrow money, and pay taxes. When a business incorporates, it issues stock to the owners of the corporation. In the days before the internet, stock was issued in the form of physical certificates. Nowadays, stock ownership is tracked as ones and zeros in computer databases. Stock represents fractional ownership of the corporation. You'll often see stock referred to as equity. Equity means ownership of a business. Stock is a specific type of equity that refers to ownership of a corporation. People that own stock in a corporation, also known as stockholders, enjoy certain benefits. The exact benefits can vary as corporations can be set up in multiple ways. But the biggest benefit is that a stockholder has a legal claim on the assets and profits of the corporation. Corporations can decide to pay dividends, which is distributing a portion of profits to stockholders. If a stockholder owns 15% of a corporation, the corporation then decides to pay dividends, that stockholder will receive 15% of the total dividends paid out. Similarly, if the corporation is sold, the stockholder would receive 15% of the proceeds from the sale. When people talk about how much stock they own in a corporation, they will typically say the number of shares they own rather than the percentage of the corporation they own. That's because the total number of shares in a corporation can change over time. Now that we know what stock is, you can probably guess that a stock market is a place where people can buy and sell stock in different corporations. That's pretty much correct, though there's a bit of nuance that we should get into. When people refer to the stock market, they typically are referring to corporations that are publicly traded. If a corporation is publicly traded, it means that at least a portion of its stock is available to anyone in the general public to buy and sell. In the US, the market for shares of publicly traded corporations is regulated by the Securities and Exchange Commission, or the SEC. A publicly traded corporation is subject to many reporting requirements, chief of which is the issuance of quarterly financial statements that fairly present the economic condition of the business. While your favorite local pizza shop may be organized as a corporation, it almost certainly isn't a publicly traded corporation. In order to issue shares to the general public, corporations must meet, among other items, lofty revenue requirements. A corporation may decide to go public and have an initial public offering or IPO. A corporation doing this has probably been in business for years and senses it can grow the business with the quick and potentially giant influx of cash from an IPO. During an IPO, anyone in the general public can buy shares of the corporation directly from the corporation. After the IPO, the people who bought shares are then free to sell their shares in the stock market. For the uninitiated, a show on CNBC or a visit to Yahoo Finance can seem like a foreign language. Let's demystify how people talk about the stock market by breaking down a picture from a CNBC broadcast. Here we have a pundit talking about a particular corporation's stock. First, you probably noticed the acronym. When corporations go public, they are required to register a unique 1 to 4 letter acronym. This is done so that stock prices can be reported on quickly and efficiently. For most corporations, such as Apple, these acronyms are pretty straightforward. For others, like Ford or Coca-Cola, the acronym may not be immediately recognizable. You probably noticed two numbers, each going to 2 decimal places. The larger number is the market price for a single share of the company. The smaller the number, the smaller number is the change in stock price represented in dollars from the close of the previous business day. Then you'll see a percentage to 2 decimal places right next to the stock price. If the percentage is positive, the font will be green. If the percentage is negative, the font will be red. This represents the movement of the stock price from the close of the previous business day, this time as a percentage and not in dollars. Above the stock price, there are the letters YTD with a percentage next to it. YTD means year to date. The percentage next to it represents the percentage decline of the stock price since the first business day of the year. When looking up stock prices online, you can see how the price has fluctuated over certain time periods, such as year to date, 1 year, 5 years, and even the entire period that the stock has been publicly traded. When people talk about how good or bad the stock market is doing, they'll often talk about how a particular stock index is doing. A stock index is an aggregation of stock prices for different companies. The most popular stock index is probably the S&P 500. There are some nuances, but essentially the S&P 500 tracks the top 500 publicly traded companies as measured by market capitalization. S&P stands for Standard & Poor's, which is a private company that maintains the index. The performance of the S&P 500 is thought of as a reliable indicator of how the stock market and even the broader economy is doing. Another popular stock index is the Dow Jones Industrial Average, or often referred to as just the Dow. This index goes back a ways. It was created in 1896 by Charles Dow, one of the founders of the Wall Street Journal. The index includes 30 publicly traded companies. These are some of the biggest companies out there, but the selection criteria is a bit more arbitrary than the S&P 500. There's plenty more to be said about the stock market, but we'll leave it there for now. What do you think? Does this apply to your life? Leave a comment below, and thanks for watching.